Well, the roller coaster ride for stocks has rattled Wall Street deal makers. We are back with Evercore Partners President and CEO Ralph Schlosstein. Also joining us to talk about deal making in this post-downgrade climate, you could say, is Bloomberg's deals desk reporter Cristina Alesci, and also the co-president of Thomas H. Lee Partners, Scott Sperling. Scott, thanks so much for joining the conversation. Just simple question. This volatility we've seen in the last several days, is that going to hold back M&A?
I don't think volatility will hold back M&A over the long time. I think it's the uncertainty about the economy itself that flows into the assessment we have about the underlying value of a business over some 3 to 5 year period that would cause us to slow down the deals that we're actually committing to. Unless we see prices reflect the uncertainties and therefore the risk of that transaction. But the volatility itself in the overall markets is something that we can live with.
It's more what the volatility does to the economy is what you're saying.
More than what it does to the economy. Many people think that we need frothy credit markets in order to have a robust buyout situation. And in fact, the opposite in many ways is true. I'd rather pay a much lower price reflecting a tougher credit market using lower leverage and putting in a higher equity percentage, but at a price that provides us more protection against the risks of the economy and better reflects the intrinsic value of that business. So we're actually not unhappy if the credit markets slow down a little bit.
So you're saying that deal making won't technically, this is not technically bad for deal making.
It's not technically bad for deal making.
But on the flip side, though, on the IPO side of things, I mean, that could materially impact private equity business, especially because private equity firms really took advantage of the fact in the beginning of the year the IPO market was hot. You know, your firm helped bring Nielsen and Dunkin to market.
Yes.
You know, is that the biggest threat out there right now, or is there another threat for PE businesses?
Yeah, I would say that if we're in a very long-term situation where there's no IPO market, it does make it harder on the overall private equity business, no doubt. We have investors that are looking for liquidity over some intermediate to longer-term time period, and having access to the IPO market, which is not a liquidity event itself, because we generally don't sell our stock. So we don't sell very much on Dunkin' Donuts, nothing in the primary, only in the green shoe, and similarly in Nielsen, we still hold most of our stock.
Right.
However, it does position us and the other investors to be able to access the markets for liquidity over a 3, 5, 7 year period. If we were in an extended period of time where the IPO market went away, you're exactly right. Our hope is that markets will stabilize at some price level that makes sense, reflects the realities of the economic environment, and that you will once again have an IPO market come up. But we like good IPO markets, no doubt.
Ralph, is this something, I mean, do you agree mostly overall with what he's saying on this front?
I do agree. I think the critical question from this very moment is not how much did stocks go up or how much did stocks go down last week or yesterday or the day before. The critical question is what's the future direction of the economy and what effect does that have on business activity and the value of businesses. And you know, if you know an economist who has a model that projects out what a up 600 or down 600, up 400 successive days in the equity market will have on economic growth, employment, and consumer confidence, I'd like to meet that person.
Could be very valuable. Ralph, thank you very much. Also to Scott Sperling of Thomas H. Lee Partners.